Good afternoon, everyone. This is Anna and Jim in our show, Live with Main Street. How is everybody doing today? Jim, welcome.
Thank you. I'm glad to be back in the United States.
Oh, am I glad for you to be back?
Working hard remotely from Italy.
There you go. I know you've had lots of fun. So where are you at, Jim, today?
I'm in Washington, D.C.
Oh, there you go. Well, I am all the way in San Francisco, so here we can still have our show, regardless where we're located. That's the remote life.
For our clients, we have clients all over the world, so we just have to use these kinds of tools.
We do. And today, what are we talking about today, Jim? Our theme is investments, right?
Well, it's July. Vacation is over for some people like me. And so now it's time to take a look at what we're invested in, securities and real estate and other businesses, things that we do. And so that's what we're going to talk about and blog about this month.
Yes, it's an exciting theme. But before we get into the details of what and how we should be investing, there's a topic that we want to discuss today with all of our listeners. And then maybe perhaps later we can talk specifics of what types of investments and that. So have you ever looked up a definition of what investment means in a dictionary? I actually did right before this session because I wanted to use it. But here's what a dictionary defines the word investment. It's an action or process of investing either capital, your time, or your energy for the profit or material result. So I want you to keep that in mind as we're discussing the session with you today, because it's not always investments in stocks and bonds and real estate, as Jim mentioned before. There's a lot more goes in the background, and it kind of aligns with what Jim would like to share with you today. But there are these biases and fears that we all have that sometimes prevent us from taking steps in the right direction so that you can either invest your money, your time or energy in getting the results that you want. So Jim, I'd like you to share with our listeners today, what are some of those biases that exist out there? And do we have solutions or recommendations of how to overcome them?
Certainly we do. Anna, and thank you for letting me talk about biases. There's a area of study and research, and it's labeled behavioral finance. So it's in the psychology area. And there's been plenty of books and articles written about it. And in getting ready for our session, just like you looked up the word investments and tried to see what that meant, I looked up behavioral finance biases, and I came up with an article that detailed 130 biases. I was hoping to cover 5 or 10.
Yes, please do.
And I came up with 7, okay,
good,
but not 130. But there are different things that go on in our brain and our experience that don't help us become good investors, whether it's whatever we're investing in. The first one I'd like to mention is confirmation bias. It means that we make a decision to do something, and then we look for articles or people or television shows that confirm our bias. It's called confirmation bias. For example, in my case, where I believe strongly in mostly passive investing in index funds, I'm always looking for articles that make me feel good, that confirm that investing in index funds is the way to go. But I could be subject to confirmation bias, and that means that, like a good investor, I should be reading articles that talk about how to pick the 10 best stocks this year. So I do read those things too, because I don't want to commit that kind of a sin. The other bias that's next on my list is called loss aversion. And that means that I'm trying to avoid pain. And that's a human frailty. It's the fight or flight. Most of us run away from bad things happening to us. And a downturn in the market is something that really scares most people. And therefore they make rash decisions about getting out of the market because they want to avoid the pain that they suffered last time the market went down. Because the first time it happens to you, you ride the horse down the hill real fast, and then you realize how much it hurts. So then in the future, you do things that aren't in your best interest to avoid the pain of the loss you suffered last time. The third one is mental accounting. Sometimes we look at money differently based upon how we got the money. Now at work, we have a job and a paycheck, and we put money away for different goals like retirement or college education or weddings or whatever. But sometimes we get money other ways, like an inheritance. And people tend to view money differently based on where it came from. So, and rather than being rational, sometimes we'll say, well, I didn't expect that aunt to die and leave me $20,000, so I'm going to go out and blow it on the down payment on this big, hot new Mustang that I really want, you know, because now I can afford a $50,000 Mustang because I've got the $20,000 on the down payment. So that's mental accounting. The next bias is illusion of control. And the best way that I can demonstrate that is between cars and airplanes. I would rather drive because I feel like I'm in control versus get on an airplane where the pilot's in control. The trouble is that's an illusion. If you look at the statistics, it's much safer to travel by airplane than it is by car. But we have this illusion of control. But when somebody rear ends us at the stoplight, we didn't have any control about that.
No, exactly.
So when it comes to investing, it's the same thing. We want to pick the stocks and bonds rather than put an index because we know when it's time to get out of Ford Motor Company. Guess what, folks? It's too late to get out of Ford Motor Company.
Yes, and I don't think any of us really know for sure. So it's always
an
yes.
illusion of control. And then we have probably the most frequent one that I come across myself and other people, recency bias. The market's going up, so our brain thinks it'll continue to go up. Now the market's going down, so I got to get out of the market because it's just going to go down, down, down. It's never going to end. That's recency bias. Hindsight bias is where a lot of times people get into bragging about their investments, Anna, because in hindsight, they were 2020. I knew Trump would win. I knew the stock market would go up, you know, and now I'm a genius. Trouble is, our friends on the business TV channels can't find anybody with hindsight bias for that event that I just described, right, because nobody got it right. But there is a bias in hindsight because it's always 2020, we say. The last one is herd mentality. Gold, we got to get into gold. And we saw that a few years ago as advisors when gold kind of went over $1,000 an ounce. People started emailing us and calling us and say, shouldn't I have gold in my portfolio? Shouldn't it be good? And when it got to 1,600, they were frantic. Well, the people that got in at 1,600 that just couldn't hold themselves back anymore, it's now at 1,200. They lost 25% of their investment. So that's herd mentality. It's another bias to avoid. Those are the big seven. And Anna, let's turn it over to you.
Yeah, so I wanted to talk about fears, and you've I think these fears that I identified as sort of the most common, what we see with our clients and ourselves too. We're not any different, right? So they kind of go hand in hand with the biases because again, that's how our brain is working against us most of the time. So the number one fear is, I think a lot of us have, and what stops us from taking the steps is not having enough experience or not having enough knowledge, right? How many clients do we always get that say, well, I don't really know how to do that, right? And that's why they're coming to us for help. So I think, and so I don't want to just talk about the fears because we can identify what they are. I want to have practical solutions. So if you don't know something, right, or you don't know how to do something, why don't you align yourself with the right people who can get you in that right direction? Now, with investing also comes the complexity, and it could be fees, right? There are lots of different fees for different investments, types of investments. We talked about stocks, bonds, mutual funds, index funds, and real estate, and you can get really complicated and sophisticated if you really wanted to, but sometimes all of that is sort of being thrown at us, and we're kind of like, you know, hiding under, you know, and trying to figure out, okay, well, what should I do? So, right, we as financial planners, had to go to school to learn a lot about all of these complexities. And so again, going back to my point number one is align yourself with people who know and who can hold your hand and recommend what you're supposed to be doing. Now, I think the solution I want to propose to this whole investing game is really to step back and look at what you have, right? Because if you don't know specifically what are you investing for, picking the vehicle isn't going to help you. Because if you know your ending point, then you can step back and say, okay, a very simple example I can give is, let's say you want to buy a house in 2 years, and you're saving for a down payment on that house, whatever that number is. So if you were to ask an advisor like somebody at MainStreet, we definitely wouldn't be recommending you investing in stocks or investments that have a lot of volatility and subject, if the market changes, subject to fluctuations. So now we know the goal, which is buying a house, and we know that it's happening in the next 2 years. So that means we need to look into something that gives us a more certain ending result. So again, going back and identifying what your goals are, I think is the best practical solution. Then all of these fears, right, and biases, they're always going to be there. But at least if you have a plan, then you can align yourself with the right people. You can have a strategy. And then the last piece, right, that's how we always work, is what are the goals, and then how do the investments are aligned with that? Because at the end of the day, why are we going to invest if we're not going to invest in something that's going to give us the results that we want? So that's what I had, Jim, to share with our listeners today. Now, I do have a special announcement. I just launched my 5-week bootcamp called Money Flow Bootcamp. So I'll share a link below this video, but I'm actually teaching. And actually, one of the things I also should have mentioned is that even with investments, I'd like to recommend to start with the basics. Make sure you understand what the basics are, right? Because it could get complicated. So the theme for the Money Bootcamp is actually helping you manage your sort of day-to-day operations, your bill pay, your tracking. And so I'm always advocating, if you could get a hold of that, then everything else will align and you won't have as much fear or stress about what's going on. So if you're interested, check out the link below. We're going to be back here again next month. We're not sure what our topic is yet, but hopefully investments is going to be entertaining this month. And look out for our articles. And I think we have an interview, don't we, Jim, coming up?
Now we do have it with Kent Grealish. That's coming up. We're going to talk about are simple portfolios good enough? Will simple portfolios get us where we want to go? Anna, as an end, I wanted to recommend people a book to go into more detail about this behavioral finance. It's written by Jason Zweig, who is the personal finance editor at the Wall Street Journal. He wrote it when he was at Forbes magazine. The name of the book is Your Money and Your Brain. And so you can try to, through reading this book, try to understand how your brain works as far as investing goes, and how Wall Street might on occasion manipulate you because they know how your brain works. So we want consumers to be armed with knowledge and experience, and reading the book, Your Money and Your Brain, is a good way to recognize your own biases, either through living or what your parents taught you, etc. So I just wanted to add that.
Wow, nice. That's definitely a book we've been recommending for a long time. And so, yes. Good. Okay. Well, great, Jim. I enjoyed our session today. Everybody have a great the rest of your day, and we'll be back next month. Take care.
Bye, everybody.